And to know more about the debt ratio, joining me today, personal finance enthusiast Dani Rachmat. Thanks for dropping by.
Thank you for having
All
me
right,
always.
so we're gonna talk about the debt equity ratio,
Debt
ratio. So
Yes.
we already talked about scheme companies, EPS, book value. We talked about uh, price to book value,
and then
price to
it's
earning.
To earning, yeah.
All right, so debt ratio, simplify, is a financial ratio that measures the extent
Of company's leverage.
company's leverage. So talk about this. So debt ratio, the total debt and total assets.
Total assets, yes. This, if you see this total debt to total asset, that meaning if they have way bigger than debt compared to their assets, we can say that they use debt to finance their purchasing of assets.
Okay.
That will be if the debt is way bigger than its assets, we can say that it can, like, on a balance sheet,
Okay.
we can say that
So if it's bigger than assets,
this is very dangerous, because in the balance sheet can I write
Yes.
this? This one is asset, right?
okay,
And this one is liability.
okay, which is the other word for debt.
Yes. Which in it we
There's-
have debt,
oh, there's included
and
debts
we have
inside.
equity here.
Okay,
So the total here, this one must be the same with this one. So if they have way bigger debt than total assets, meaning that this one is bigger than this one, right?
yes.
So equity is negative.
All right.
That will be a very dangerous situation.
That's a danger. So you don't want this. You want to
Yes.
actually have at least an equal.
Even if equal, meaning that if equal, assets equal to debt,
Okay.
equity is zero.
All right.
If the equity of the company is zero, then you can say that the shareholder of the company don't have any commitment to that
To
company.
the company. All right.
Yes.
So let's take a look at some example. We've been looking at
Yeah.
Apple. So let's take a look at Apple from 2020, 21, 22, 23. So we have the assets right here on the blue, and then we have on the gray is the liabilities.
The
So tell us
liabilities.
what's going on here.
Yeah, actually for liabilities, there are so many other components other than debts
Okay.
in the liabilities. But then we can see this one is liabilities, right? This one is equity.
Okay.
We see that for the Apple here still have some equity, but we can see that to finance their asset, because total asset is the same with the total debt and total liabilities, right?
All right.
For the assets that they have, 352 billion,
Billion. Yes.
it is mostly financed by liabilities, whether is it debt or whether is it
By the-
third party, what's it, loan,
Okay.
or maybe bank debt, or maybe bonds and everything. Their
Interesting.
equity is very small. So if we can say that Apple
the
mostly finance their asset using the liabilities, or most probably debt there.
All right, so let's take a look at this one. So the LT debt to equity right now is 123%,
Yes.
and total debt to equity is 140. So tell
Yeah.
me, what's going on with this number?
We can see that the debt of Apple is 1.23 times of the equity.
Okay.
So that if also sudden everything goes bad and the debtor wants to call their
They
loan,
become one us
Yeah.
to collect, yes.
Apple can only pay like 1 times from the equity, and there's still remaining debt that is
They
still
have to
unpaid.
pay. All right.
Yes.
Okay, so,
So with that, when Apple liquidate all of their assets, meaning that probability that when we invest in Apple, we are the investor of the stock, right?
right.
So we will get paid
The way
least.
later.
Yeah, the way
So-
later.
So for you folks at home to understand, when the debtors actually, when the bank's trying to collect, the first thing that the company have to pay is actually the
debtor.
the debt.
Yeah,
first.
the priority will be the employee first for the unpaid salary,
yes.
and then the debtor. So
right.
the very last one is the
It's going to be the investor with
Yes.
the shares. All right, so next one, we're going to look at the Microsoft. Now, Microsoft, it looks like they have a higher assets compared to liabilities,
Yes.
compared to Apple.
Compared to Apple.
Alright, so-
We can see here that for the total asset is like twice of the liabilities or
Okay.
twice of the equity. So that we can safely say that, okay, Microsoft finance their asset that they have to purchase their asset only half using the debt.
All right.
So they use their own money here.
All right, so let's take a
At
look
least
at
for
the
the
debt to
half.
equity right here. So 16.85, wow, way lower
Very,
than
very small. This is
Okay.
very, very small. Only 0.16 times of
Then
its equity.
of
So
the
that
equity.
if the debtors call the debt and ask Microsoft to pay, they can easily pay off the
All
loan.
right, so before we continue, I want to just put disclaimer out there. This is only information only. We're not
Only
saying
on the debt to equity.
and do it debt to equity.
Yes.
Again, we have been going through their
So many
price
things
to
before.
earnings, like
Yeah.
their price to book value. So we're just looking at like how much does the company actually own
Own, yes.
for the operational or whatever it is
Yes,
that
yes.
they have. Now, tell me what's going on with the total debt to equity.
Total
right here?
debt to equity, this is, sorry. This one, the first row is long-term debt to equity.
Okay.
So long-term debt is very small, while total debt to equity is only half of the equity. So that even though
still-
they have to repay all of their loan, they still have half of the equity, and the company can still run.
All right. So
Yeah.
we already look at Apple and then we already look at Microsoft. Now let's take take a look at Tesla. So again, it looks like 2023 they has a lot more assets compared to
Yes,
their
this
liabilities.
one is for the latest one, right?
Honestly, I was kind of surprised because like
Yeah.
electric
I-
sales have been.
I
it's been
thought
really-
this will be this company will have more liabilities compared to their equity, but when we see that
Sorry.
the equity is way bigger than their total liabilities, even.
Yes.
So for the debt, I assume that it will much lower.
All right. So
See,
the
even
debt
lower
to
than
long term is
Microsoft.
only 4.25% or 0.04.
Looking at this, maybe we can say that people buying Tesla, they will pay like not so long term of the loan, or maybe that they took, what is it? Financing
Okay.
to buy the
For the
car.
cars, okay.
So they pay outright so that they have cash.
So basically, when Tesla sell their cars, they already make money right away.
Yes,
without
right away.
and then
So they don't
all the
need
productions and
yeah,
stuff like that.
They only have like total debt only 15%, 0.15 times of the equity. So that they still have like what 99.85% of the equity
All right.
if they repay all the debt.
That's interesting. Now, we already talked about how to scheme it, EPS, book value, PVP, the price to earning, now debt ratio. Now, how does this debt to equity ratio come into when you decide your...
Actually, when looking at debt ratio, it's not solely we see that the higher the debt, the more dangerous the company will be. But we can see that the management can share the risk, the financing risk of the company to other parties instead of using their own money.
Interesting.
So that when something happens, the asset that the company have is secured, and then they are sharing risk with the investor, with the debtors, and everyone. So the trust to the company is quite high.
All right, so
But
that
then-
can be shown from any other, like the price to book value, price to earning, like that's how much trust that
Yes,
companies.
yes.
Okay, interesting.
And the lower the debt level can also be seen as a negative side, that not so many people believe them, so that not so many people want to lend money to them.
Which is kind of explain about Tesla with his owner and CEO.
We don't know about that. Very interesting discussion.
Right,
about-
that's gonna be a whole different discussion. But again, for those at home, again, this is only information only. Again, please if you have any questions, please go to your financial advisors to seek what do you want to invest on, and then all this we just showing you is for information only. Well, with that, we're going for a break. When we return, we'll have a recap of the first session of trading in the Indonesian Stock Exchange. You don't want to miss. We'll be right back.